Well, welcome everybody. Thank you very much for coming and joining us today. I have a great pleasure to introduce today's speaker and to thank Governor Rich Clarida for visiting the Cleveland Fed and participating in a very busy day and busy evening of activities with us. So Richard Clarida joined the Federal Reserve Board of Governors in 2018 as vice chair. And he's been a very strong contributor to all of the activities of the board and the FOMC since he arrived. As many of you know, Rich played a critical role in leading the FOMC's framework review of monetary policy, which resulted in the revision of the strategy we're using to set monetary policy. Rich joined the Fed with experience not only as an academic who studied monetary policy, but also as a financial market participant. Rich was the C. Lowell Harris Professor of Economics and International Affairs at Columbia University, where he taught from 1988 to 2018 and served as chair of the economics department for 4 years. Maybe you can sing Roar Lion Roar later for our audience here. He's also been a member of the NBER and co-editor of the NBER International Macroeconomics Annual. Now, his private sector experience includes serving as a global strategic advisor and managing director of PIMCO. And that experience, his experience has served the FOMC and the public very well because Rich has been able to apply his very strong understanding of economics, both theoretical models and empirical methods, to help guide policy decisions and combine that foundation with his in-depth knowledge of how markets and institutions actually work in practice. And that is actually a rare combination of knowledge and expertise of the theory and practice. And it's been of critical importance as monetary policymakers have had to handle the uncertain effects of the pandemic on household, businesses, and financial markets. Rich's expertise and his curiosity, which leads him to not only tolerate, but to invite alternative views, have earned him the deepest respect of his colleagues on the FOMC, as well as that of Fed watchers and academics. Rich's service at the Fed continued a commitment to public service that he has shown over his career. Rich was a senior staff economist on the Council of Economic Advisors under President Reagan, and he served as Assistant Secretary of the U.S. Treasury for Economic Policy from 2002 to 2003. So we are in for a real treat today as Rich first presents some remarks, and then we engage in a conversation about the economy and monetary policy. Please join me in welcoming Rich.
Loretta, thank you so much for that kind and generous introduction. And I've really been looking forward to this event for almost 2 years. I mentioned to Loretta pre-pandemic that I was hoping to visit the Cleveland Fed in the spring or summer of 2020, and a funny thing happened on the way to that visit. But I didn't lose interest in the visit, and so we reconnected in the fall, and I'm really thrilled to be here. Loretta did mention my service as a staff economist with the Council of Economic Advisors. I'll share a personal anecdote about that. So very proudly in my study at home, I have a picture of me 30 plus years ago shaking hands with President Reagan. And my younger son, when he was in kindergarten or first grade, one day came home and said, so Dad, did you work for President Reagan? I said, that's right. He said, well, then you must know President Lincoln. You know, the Illinois connection in common, but he now understands the difference. But moving away from personal anecdotes, I thought what I'd do today is to offer some initial remarks before my conversation and dialogue with Loretta about a very important topic for all of us on the FOMC, the presidents and the governors. And that's the topic of Federal Reserve independence and its foundations and responsibilities. And in particular, use some general remarks on that to talk about the actions that the Federal Reserve took, not only in the global financial crisis, but also most recently in what I call the global pandemic collapse. We can't forget just 15 or 18 months ago the severe blow that the US and global economies absorbed in the shutting down of the economy in the pandemic collapse. GDP collapsed at nearly a 33% annual rate in the second quarter of 2020. More than 22 million jobs were lost in just the first 2 months of the crisis. And the unemployment rate rose from a 50-year low of 3.5% to a post-war peak of almost 15% just 2 months later. It's easy to also forget that a precipitous decline in aggregate demand last year actually was very disinflationary, and inflation fell well below our 2% objective. The resulting disruptions to activity tightened financial conditions and impaired the flow of credit to U.S. households and businesses. Now, the fiscal and monetary policy response to the COVID crisis was unprecedented in scale, scope, and speed. Legislation passed by the Congress in March of 2020, December of 2020, and March of 2021 provided a total of nearly $6 trillion in fiscal support to the U.S. economy, about 28% of GDP. The Federal Reserve, and Loretta and I remember this very well, we acted decisively and with dispatch to deploy each and every tool in our toolkit to design, develop, and launch within weeks a series of innovative facilities to support the flow of credit to households and businesses. The facilities that the Federal Reserve either relaunched or designed and developed anew in response to the crisis were established under authority of something called Section 13.3 of the Federal Reserve Act. So if there's anything you remember today, it's 13.3. Under Section 13.3, Federal Reserve facilities can be established under, quote, unusual and exigent circumstances, and only with the approval of the Treasury Secretary. Section 13.3 has been on the books since the Great Depression, but it was only invoked for the first time in the global financial crisis. Now, the global pandemic collapse in the spring of 2020 was the second occasion in the past dozen years in which the Fed invoked its emergency lending powers to help forestall severe financial market disruption, the first occasion being the global financial crisis of 2008 and 9. And so in my remarks today, I'd like to reflect on the Federal Reserve's response to the GPC in the context of our institution's history and structure, and to highlight not only the privileges that flow from, but also the responsibilities that are necessary to respect our institutional independence. Now let's begin with some history. I promise this won't be boring, and I'll be brief. At the urging of Treasury Secretary Alexander Hamilton, the first Congress of the United States established the first Bank of the United States in 1791. Like similar institutions in other countries, the first Bank of the United States was owned by the private sector, was publicly chartered, and carried out some operations that would be thought of today as those of a central bank. The first bank played a key role in executing Hamilton's vision to put the young government's finances on a sound footing, to promote the stabilization of the purchasing power of the dollar, and to support economic growth. Nevertheless, that first bank became embroiled in politics, and the Congress failed to renew its 20-year charter in 1811. In 1816, the Congress did charter a second Bank of the United States, which was designed along similar lines to its predecessor, but it too generated political controversy. In particular, a president named Andrew Jackson was not a fan, and he was not shy in saying so. And so that second bank's charter expired without renewal in 1836. So you may not know this, but for the next 77 years, the United States did not have a central bank. There was significant financial sector development during this time, with commercial banks, equity markets, and corporate bond markets all playing a role in financial intermediation. However, this period also witnessed several major financial panics that substantially disrupted economic activity. One of those panics, the Panic of 1907, galvanized Congress to establish a new central bank. The Federal Reserve was chartered by the Congress in 1913 and directed specifically to promote the stability of the financial system. An important goal of the Fed in those early years was to smooth the large seasonal swings in interest rate and credit conditions associated with the harvest season that in the past had contributed to financial panics. The principal tool provided in the Federal Reserve Act to accomplish this goal was the ability of the Federal Reserve to lend funds to commercial banks against collateral through its discount window. Through the compromises and choices made in designing the Fed system, the Congress created an institution that received broader and more durable public and political support than had been the case for the first and second banks of the United States. At the center of the Federal Reserve System was the Federal Reserve Board, comprised of public officials nominated by the President and confirmed by the Senate. In this initial carnation, it's interesting to note, the board also included the Secretary of the Treasury as an ex officio member. The Federal Reserve System, from its inception on day one, included 12 Federal Reserve banks distributed across geographic districts, which were designed to be responsive to and report on regional economic conditions. Now, although the Congress assigned to the Federal Reserve a statutory set of goals and tools, policymakers from the very first days had substantial independence in how they used those tools to pursue the assigned goals. For example, the interest rate charged on discount window loans was set by the Federal Reserve policymakers with little or no interference from Congress or the executive branch. The same was true of Fed purchases or sales of Treasury securities. These open market operations were found over time to be another effective tool with which to influence overall financial conditions. Now, in response to the Great Depression and reflecting a growing recognition that the Fed's original institutional design was in need of improvement, the Congress restructured the Federal Reserve System in the 1930s. And the modern Fed, as we know it today, was really the product of those efforts. Greater authority over policy decisions was placed with the board, whose members, given their nomination and Senate confirmation, were thought to be more clearly accountable to the nation as a whole. At the same time, the Congress gave the board increased independence from the executive branch by removing the Secretary of Treasury's status as an ex officio member. Decisions regarding open market purchases of U.S. securities, which were becoming a more important monetary policy tool, were assigned by statute to a federal open market committee, which consists of members of the Board of Governors and a rotating subset of Reserve Bank presidents. Obviously very important here in Cleveland, given the rotation every other year. In the FOMC structure set up in the mid-1930s and remaining in force today, 5 Reserve Bank presidents are voting members of the FOMC at any one time, leaving the 7 board governors, and I should say if there are 7 board governors, because in recent years that's not often been the case, putting the 7 governors in a majority position. Now, this arrangement has served the Federal Reserve quite well during the past 85 years, as it promotes a diversity of views and a healthy debate regarding the political options available. It's also worth noting a distinction that bears on decision-making powers regarding monetary policy and lending policy. In contrast to monetary policy, which is by statute an FOMC decision, the power to make decisions about the Federal Reserve lending programs, in particular the 13.3 programs, resides solely with the board. Subsequent decades saw further changes to the governance of monetary policy. A notable and historic development occurred in 1951 when the Federal Reserve obtained its current level of independence from the Treasury as codified in a Treasury-Federal Reserve Accord. Another milestone occurred with the Federal Reserve Reform Act of 1977, which assigned the Fed its current statutory mandate to achieve price stability and maximum employment. Monetary policy had in effect pursued these goals since the Accord, and the Federal Reserve maximum employment and price stability goals had been embedded in previous acts of Congress. But the statutory formulation of this dual mandate was important in specifying congressional intent and defining the Fed's goals. And I should point out that many other central banks in the world do not have a dual mandate, so the Fed is somewhat unusual in that regard. In the decades after the Great Depression, while systemic financial disruptions in the U.S. were not unknown, systemic liquidity crises were relatively uncommon. And the Federal Reserve was able to address the disturbances that did occur using its traditional tools of providing discount window loans to banks, a tool that had been in the toolkit since 1913. Now, this half-century of relative financial stability in the U.S. was shattered in 2008 by the global financial crisis, a crisis that disrupted financial markets and impaired financial intermediation around the world. In the United States, many of the most severe disruptions occurred in wholesale funding markets and involved non-bank financial firms. These non-bank financial institutions, which have become a major source of financial intermediation in the U.S., page turn, in the decades leading up to the GFC, were typically lightly regulated, highly leveraged, and overly reliant on unstable sources of short-term funding. And because they were not banks, the Fed would have faced enormous challenges stemming the crisis by use of traditional discount window lending to depository institutions. Funding markets during the global financial crisis faced enormous stress. A number of major firms failed. Fannie Mae and Freddie Mac were forced into conservatorship, and the flow of credit to businesses and households was severely impaired. The Fed responded by using not only its traditional authority to lend to banks, but also for the first time, its authority to lend to non-bank institutions under Section 13.3 of the Act. The GFC emergency lending facilities that were stood up under this authority were designed to support short-term funding markets and to provide loans to non-bank financial firms, which in turn could then continue to intermediate credit to the private sector. The Federal Reserve also made Section 13.3 loans to individual distressed non-bank firms like Bear Stearns and the AIG group. The Federal Reserve's emergency lending programs established during the GFC stabilized the financial system and helped to prevent another Great Depression. Consistent with the central bank's statutory authority, the facilities were designed to minimize the Fed's exposure to credit risk, and all the facilities were wound down over time without any loss to taxpayers. Now, in the wake of the GFC, the Congress made several changes to the Federal Reserve's emergency lending authority. First, the Fed would be required to provide loans to non-banks only through broad-based facilities. Bilateral loans to individual non-bank firms were no longer permissible. Second, all the emergency lending programs would now require the explicit approval of the Treasury Secretary. Third, the Federal Reserve going forward would be required to provide enhanced and timely transparency with regard to any emergency lending facility set up under Section 13.3. In addition to these changes to the Fed's authority, the GFC also spurred wide-ranging financial regulatory reforms, in particular the Dodd-Frank Act, meant to improve the stability of the financial system. The Fed's experience in the GFC reinforced a set of important principles guiding how it would respond to a future systemic financial crisis. There are four that I would highlight. Act rapidly, decisively, act on large scale and with a variety of tools, be mindful that announcement effects can be vital for promoting confidence, and design and price facilities as backstops to smooth the return to private sector intermediation as quickly as possible. Now, the lessons learned from the Fed's response to the GFC were invaluable, as it had to assess, develop, and execute its response to the GPC in a matter of weeks. In the first 2 weeks of March 2020, the FOMC lowered the target range for the funds rate by 1.5 percentage points, thereby bringing the funds rate to its effective lower bound, which in the U.S. we think of as 0. The committee also provided forward guidance on the funds rate, stating that it expected to maintain existing target range until it was, quote, confident that the economy had weathered recent events and was on track to achieve its maximum employment and price stability goals. In addition, the Federal Reserve engaged in substantial purchases of Treasury securities and agency MBS to support market functioning and further ease financial conditions. Reflecting the heightened uncertainty of March of 2020, there was a surge in demand for liquidity across the global financial system. Spreads in some short-term credit markets surged to levels last seen, though, in the 2008 crisis. Investors ran on prime and tax-exempt money market funds, and some firms found it difficult to obtain the credit needed to finance critical operations. Many businesses sought to draw down lines of credit with banks to augment the amount of liquidity they had readily available. To relieve these strains, the Fed encouraged depository institutions to turn to the discount window, lowered the rate on discount window borrowing, and made it easier for institutions to borrow from the Federal Reserve at longer maturities. As conditions in the U.S. credit markets were severely stressed, the board determined once again that circumstances were unusual and exigent and acted rapidly and decisively to prevent financial collapse. With the approval of the Treasury, and in some cases, drawing on equity capital invested by the Treasury, which in turn drew on appropriated funds from Congress, the Fed announced and stood up several 13.3 short-term liquidity facilities similar to those established during the GFC. And because dollar funding pressures were not limited to the U.S., the Federal Reserve stabilized global dollar funding markets by expanding its swap line arrangements with foreign central banks and by lending dollars against U.S. Treasury securities to foreign central banks. Against the backdrop of concerns about major economic disruptions stemming from the pandemic, strains also emerged in the corporate bond market, the municipal debt market, and asset-backed securities markets. Issuance of new debt in these markets slowed sharply, and the cost of corporate credit increased considerably. Financing challenges were also faced by state and local governments, as well as by small and medium-sized businesses traditionally reliant on bank lending. In response to the crisis, Congress passed the CARES Act in late March of 2020. The legislation authorized the Treasury to make sizable equity investments in Federal Reserve 13.3 facilities, and those funds were appropriated by Congress and exceeded $450 billion. On the basis of this legislation, the Federal Reserve established several novel 13.3 lending facilities to promote intermediation in credit markets. Among other measures, the Fed purchased corporate bonds in the secondary market under the corporate credit facilities, made loans to smaller non-financial institutions through the Main Street Lending Program, and made loans to local governments through the municipal lending facility. These 13.3 facilities promoted the flow of credit to households and businesses and helped stabilize financial and economic conditions. It's notable that they accomplished their goals even though credit provided directly by the facilities was priced in a manner consistent with their status as backstops rather than full-fledged replacements for private sector intermediation. Indeed, some facilities recorded little or no use, but their very existence as backstops appeared to have contributed in substantial ways to calming markets and promoting the revival of activity in private credit markets as conditions normalized. The public health policy response to contain the COVID virus triggered an unprecedented disruption in the U.S. economy. The economic policy response was equally unprecedented, as I've described, because of the breadth and depth of the dislocation in the U.S. financial system. The Fed's credit facilities had to be designed to reach counterparties well beyond those associated with traditional lending facilities. The Federal Reserve's actions during the GPC were taken to fulfill its long-standing mandate to stem financial panics. The facilities established in 2020, in conjunction with the Federal Reserve's other actions and a robust fiscal policy response, provided crucial support to the U.S. economy as GDP was collapsing and unemployment was surging. But it's also important to remember that as the distress in financial markets abated and the economy regained its footing, the facilities were wound down, and emergency tools were appropriately put back in the toolbox with no adverse impact on credit conditions. For example, the Federal Reserve completed its sales of assets from the corporate credit facility on August 31st. Similarly, we are managing the pay down of assets in our other CARES Act facilities as they are winding down over time. In conclusion, in central banking, as in other endeavors, with privilege comes responsibility. The Federal Reserve recognizes and has acted according to the principle that its Section 13.3 authorities are to be employed only in truly unusual and exigent circumstances. And in both the GFC and the GPC, it took these responsibilities seriously and did so in a timely way. Outside of such circumstances, the Federal Reserve has been granted what we call instrument independence by Congress to set short-term interest rates and to purchase and sell U.S. government securities to achieve its assigned goals of maximum employment and price stability. Thank you for your time and attention, and I truly look forward to my conversation with Loretta. Thank you.
Well, thanks very much, Rich. That was a great talk, and a little history mixed in with a little current events. Yeah. Always a good way to start. So I couldn't help but notice, you start by talking about the global financial crisis, right, the GFC, which everyone refers to as a crisis. Yeah. And yet I think you've coined a new term for us, a new way of thinking about the pandemic. And instead of calling it a global pandemic crisis, you're calling it a collapse. And, that's very noticeable. I just hope you can tell us a little bit about what your thinking is on that and why the difference in terminology.
I spent some time on it. Our colleague and our good friend Randall Quarles has used the term the global COVID event. And that caught my attention because it certainly was an event. I actually wanted to avoid crisis because I like to believe that through our actions working together and those of the Congress, that we actually avoided a crisis. We had a collapse in activity that lasted about 3 or 4 months, but I think we avoided a crisis. It could have gone the other way, and so others may have a different term, but I think of it as a global pandemic collapse, but a crisis averted.
Okay, that makes sense to me. I hope that it turns out to be that view of the world stays with us, and that would be a good thing. So, the nice thing about your talk is you really gave us a good history lesson of the Fed and the way it was designed and the thought process behind it. And now it was redesigned over time. And I guess one of the themes in your talk was the importance of the Fed being independent in the way it can make policy decisions, monetary policy decisions, separate from shorter run political considerations. And I guess, I come from the Philly Fed and I worked for Charles Foster for many years. And of course, that's one of his big themes. What do you see the value in that is? Like, can you give us some concrete examples of where that really can come to play and really help us as we do monetary policy?
Sure. I used the term, Loretta, in the speech, which you're familiar with, is there's an academic distinction between goal independence and instrument independence. So for the Federal Reserve to have viability in our constitutional system, it has to have a statutory basis. The Fed's not in the Constitution, so if we have authority, it's from statute, and the statute assigns us goals of maximum employment, price stability, of course, in 1977, and moderate long-term interest rates, but we focus on the first two. We jointly share responsibility with other agencies on financial stability. So the goals of the Fed are set in statutory language. We have instrument independence in that Congress, neither in statute nor in practice, tries to micromanage how we raise or lower interest rates or buy or sell securities. Members of Congress can have strong opinions and express them, but we do have the instrument independence, subject to oversight by the relevant committees. We have instrument independence to achieve our goals. So why is that important? Well, there's a very large literature by economic historians and economists that having instrument independence is important to, on average, achieving good outcomes. In general, what the literature shows is that banks that have instrument independence, on average, achieve better outcomes, both in terms of lower inflation and less volatility or variability in activity. And I would also say that just in my 3+ years now, I guess 38 months being at the board, we went through some periods when we were being criticized publicly, but having that independence was, I think, quite important for us as an FOMC to reach a good outcome. And I should also say, Loretta, that one of the things I appreciated that I didn't quite appreciate before I joined the FOMC is the crucial role in our institutional design that the reserve banks play in that independence. And I think that's a very strong and resilient feature of the system. A lot of the institutional memory at the Fed is really in the reserve bank presidents, because oftentimes their term as presidents is, in the neighborhood of 10+ years in some cases. And also the different ways in which reserve bank presidents assume their responsibilities. And so I'm not quite sure if that was indeed the original intention, but the result has, I think, been to actually reinforce our independence. So I think it's a strength of our system.
I mean, it is remarkable how you can get diverse views around that FOMC table.
As we do.
Come together.
Yeah.
Right, and try and
Yeah.
do like a consensus monetary policy. It has worked, and it's kind of remarkable as an institutional historian. So, speaking of independence, I mean, one of the things that happened in the pandemic, of course, and you mentioned it in your speech, was, the Fed came in big time, acted aggressively. The fiscal authorities, the federal government came in big time, acted aggressively. And one might interpret that as, well, independence. No, they were together. They did this together. Is that kind of coordination good, bad? How do you know when it's a good thing? How do you know when it's a bad thing? How do you think about that?
Well, that's something I'll probably be thinking of for the rest of my professional life. And so these are some initial thoughts. We all lived and worked through it. I myself felt very strongly, and I certainly conveyed this to my colleagues, in the very early days, even before our emergency meeting on March 15th, I felt it was very important that if we decided to set up 13.3 facilities, and in particular, given the depth and the nature of this shock, if we felt it necessary to set up facilities that could see us extending credit to corporations or municipalities, and the like, that it was crucial that the facilities be set up to recognize that there could be losses. These weren't just liquidity programs where you're lending money against T-bills or Fannie Mae and Freddie Mac. There could have been losses under adverse scenarios. And I felt it would have been very risky for the Fed just to pretend we can go into these. And so I was a big advocate, as all my colleagues were, for having, if you will, a first loss equity slice in these facilities. Now, initially, before the CARES Act was passed, some of the early facilities we set up in the week of March 16th were actually set up with equity investments from Treasury through the Exchange Stabilization Fund. That's not unprecedented. The Exchange Stabilization Fund has been used, for example, in the Mexican crisis back in the 90s. But the Exchange Stabilization Fund only has $50 to $80 billion in it, and given the hole that we foresaw, had there not been a congressional appropriation to appropriate $450 billion for these facilities, it would have made for some tough decisions we would need to make. But in the event, the will of Congress was, we will delegate to the Fed the way the facilities are set up, so we're not going to micromanage, but we are going to appropriate funds for this piece. And so it may not surprise you to hear, I think that given the circumstances, that was an appropriate model. And as I mentioned, the facilities were designed to be backstops. In the case of the corporate facility, I don't think we made one primary market loan to a corporation. I think in the case of the Muni facility, we made two. But they did serve as a backstop. The other thing I want to say on that, Loretta, is In the speech, I didn't highlight this as I should. Although the statute requires that these facilities receive the approval of the board, the way we actually implemented the programs was by drawing on the strength and the expertise of the Reserve Bank. So, for example, Cleveland played a very important role in the Paycheck Protection Liquidity Program, the Boston Fed, New York. And so, the statute says the board has to say go or no go, but a lot of the design and execution on the facilities was done in the Reserve Banks. And so, again, I think an example of Fed at its best.
Strength of the system,
yeah.
Having the Reserve Banks with the Board of Governors. So I'm glad you mentioned the PPP liquidity facility because, as you said, Cleveland played a big role there. So I viewed that as being appropriate in the sense that, it was a small business administration program. And then the Fed, I thought, was pretty creative in sort of saying, well, how can we actually make that program more effective? And then accepting that as collateral. And making advances. So I see that kind of coordination as being totally appropriate.
Yeah.
What would be an example of something that you would feel squeamish about, not appropriate? Was there anything that was thought of during the pandemic or even in the global financial crisis? And as you know, as you mentioned, the 13.3 facilities authorities were changed after that experience. That you thought probably a step too far.
Well, I don't. Maybe I'll save that for my memoirs. What I would say is I was very comfortable with all the programs that we did launch, and was not only comfortable but felt it was essential that if we moved away from liquidity to essentially providing credit backstops, that we needed to have the recognition there could be losses and to have those first loss. To give an idea of the way the scaling worked. It depended on the program and the calculation, but many of these programs, had there been the demand, could have been scaled up to a large multiple of that $450 billion. I think Secretary Mnuchin, at one point in the dark days of March, had used the number 10 to 1. So 450 appropriated could be 4.5 trillion in lending. Obviously, it never got to that, but certainly the facilities could have been scaled up were that necessary. And I completely as well endorse the idea of pricing them as backstops. We got some criticism for that, but I viewed the design as being a success and a feature, not a bug. So
we got criticism on both sides.
On both sides.
That's probably a good indication that maybe you hit it right.
Exactly.
The moral hazard issue always comes up around facilities. And you made a point in your speech about saying how important it is that, when you're over the crisis or over the collapse, that you can unwind them. Do you have any concerns about moral hazard on these programs, or do you think that was, is that overblown, or how do you think about moral hazard when you're setting up these 13.3?
I've thought about it a lot. I would distinguish between a potential moral hazard issue in March of 2020, which I don't think was relevant. As Jay and many of us, Chair Powell and many of us said, there was nothing really wrong with the economy in February of 2020. So, many of you are macroeconomists, and we talk a lot about exogenous shocks. In the real world, there are few exogenous shocks. One of the few exogenous, maybe the only one in my lifetime we got, was in March of 2020. And so it was very clear why the economy collapsed. So there weren't any evident or obvious excesses. So I didn't feel that those programs were rewarding prior bad or excessive behavior. But, I also acknowledge that going in the future, there will be pressure on the Fed, and there will be temptation to essentially view these programs, as a normal response to a more normal or garden variety of recession. And I would certainly hope that the Fed would resist that. I think the moral hazard problems are manageable if these are truly 13.3 unusual and exigent. I would be very uncomfortable if over time they morphed into the economy slowed down for a quarter or two, unemployment went up by a point, let's do all these programs.
So let's talk a little bit about the financial markets and the turmoil that we saw in March in the Treasury market, which was unprecedented
Yeah.
and actually kind of scary at the time,
It was very scary at the time.
So, how concerned are you about those kind of structural vulnerabilities that are in some of our markets? I mean, the Treasury market is a big, globally, extremely important market. Everything's priced off of U.S. Treasuries. You know, a collapse in that market would be catastrophic. How do you think about the structural problems in that market, and what are your views of some of those suggestions for improving those markets?
There is an interagency working group that is being sort of led by the Treasurer on this. Of course, we in New York are an active participant in that, and they've just, I think, recently released a report on some of their preliminary conclusions looking at it. A lot of things happened in the Treasury market in March, but the one that was of most concern to me was that typically what happens when there's turmoil in global financial markets, there's a flight to safety and a flight to quality. We saw that, for example, Lehman Brothers collapsed in September of 2008. Obviously, Lehman Brothers, a U.S. firm, looks bad for the U.S. economy. What did people do? They bought treasuries, okay? So what was happening in that period was the economy's collapsing, credit spreads are blowing out, the stock market's collapsing, and treasury yields are going up, and they're going up a lot. So I didn't understand it as an economist. I didn't understand the signal that it was giving. And with 2020 hindsight, this report and others we're beginning to get a sense of there's some microstructure issues in terms of clearing and settlement of treasuries. There were some positioning issues, the interface between futures markets and cash markets. And so I know it's a focus of the interagency working group, and I would imagine that over time, some of the recommendations coming out of that report will be implemented. I think I would leave it at that for now.
Thanks. So, you know, you mentioned the value of having a system and the Reserve Bank, so you probably know that the Cleveland Fed under Lee Hoskins was one of the first in the system to call for an inflation target.
I do know that.
And, you know, the Fed finally, you know, adopted an explicit inflation target in 2012. And of course, you led the Fed's efforts to really do a review of our monetary policy strategy, essentially moving from what we has been termed a flexible inflation target regime to an average flexible inflation target regime. How do you think that's going so far? Do you think after a year or so, you know, we kind of have conveyed what that means to the public? How has it guided or changed how you think about policy? I'd like to hear more about that.
I think we're about 15 months into it. I would divide the 15 months since we unanimously embraced our new framework in August of 2020 into two phases. Because no central bank has really implemented an average or flexible average inflation target, in the first several months, a lot of what I and others were doing was explaining how it would work. And in particular, we linked our forward guidance in our FOMC statement in September of 2020 to our new framework. I think that around the time that folks in markets and elsewhere were beginning to become comfortable with what the new framework meant and it didn't mean, we had an unforeseen and a very big dislocation in sectoral imbalances between demand and supply, bottlenecks, global reopening, and it's been a challenge this year to communicate monetary policy. I'm not happy. I don't think Loretta, no one is happy when inflation is running at 4 or 5% when our goal is 2. And the reality is, as recently as March or April, we and private sector forecasters didn't see it. So this is, the way I would say it is communicating in this environment would be challenging under either inflation targeting or average inflation targeting. But I have certainly made clear in my speeches that this is not a success this year, and I wouldn't consider a repeat next year of inflation at this level success. One thing I would say, however, is we don't want to lose sight of the fact that the unemployment rate was 14.5% 18 months ago, and it's 4.8. So there have been enormous improvements in the labor market. I do think our forward guidance that's in place now will serve us well going forward. If the economy rebounds more quickly and we get not only to 2 but above 2% inflation, then our reaction function through our SEP projection should reflect that, and it's doing so. So it's been, I think, a challenging year for communicating and executing monetary policy, whether or not it's inflation targeting or average inflation targeting. I would also point out that one thing in our new framework we didn't change was our view, and which we talked about both in 2012 with inflation targeting and in the new statement, that supply shocks can be a challenge for monetary policy, adverse supply shocks, because they push up inflation and they push up unemployment, and that means the goals of monetary policy are in conflict, and policymakers need to form some judgments about achieving both of their goals. And so I think that's another element of our framework this year that we've been putting in practice that's really not different from the old framework.
I mean, it's an interesting time, right? Because we haven't seen this kind of tension. And plus adding on the new variant and that kind of clouds the outlook even more. Has your forecast of inflation changed over the last 3 months in view of now with Omicron? Is that affecting what your forecast is? I mean, I know you think it's going to come down, but maybe not down sharply.
Well, I look at I spend a lot of time looking at labor market indicators because ultimately, wages are a big chunk of production costs. One of the policy successes of the Fed and the fiscal response to the COVID pandemic was that even though the unemployment rate went up to 14.4%, for those workers who kept their jobs, there was not really a decline in their wages, in wage growth. Typically in a recession, wage growth plummets, nominal wage growth plummets a lot, and we didn't see that. So that's a policy success. But what it means is that coming out of this recession into the recovery, the labor market, at least looking at the indicators that I look at, is a lot tighter than it was in the last 2 recessions at a comparable point. Now, so far, wage gains, especially if you look at like the Atlanta Fed measure or the employment cost index, wage gains are healthy, but they're not out of line with the productivity we're seeing in the economy. But it's certainly something that I am focused on, and it really says, we've said we have a broad-based and inclusive that maximum employment is a broad-based and inclusive goal. We've also said, even going back to the 2012 statement, that there's no one indicator of maximum employment. So with inflation, we can say we've got the PCE index, we want it to be 2. With the labor market, there are a lot of different labor market indicators, and so you have to have some way of indexing or averaging them. I'm a big fan of the Kansas City Fed's labor market conditions index because it takes 18 or 20 different indicators and enables you to get some sense about the trends in those. And those are definitely moving in a direction that is consistent with us getting to maximum employment. Certainly well within the forecast horizon. I would just leave it at that. So in terms of my inflation forecast, in my March SEP round, I revised it up in my June SEP round and my September SEP round. We've got another SEP round coming up, so I won't get ahead of myself there. But yeah, certainly it's been the reality of this year.
So one of the key parts of the new framework is the emphasis on inflation expectations and thinking about how do you make them consistent with 2% and make your policy?
Yeah.
Can you explain, like, how do you evaluate the inflation expectations? Because again, it's another one of these nebulous things. There's lots of different ways of evaluating. There's financial market indicators. There's surveys.
Yeah. Well, I had the great good fortune in graduate school to work for and study under Benjamin Friedman. And Ben in the 70s and early 80s was very much a proponent of look at everything, but in a sensible way. And so I followed Ben's advice. I don't like to put all of my eggs in any one basket. We have friends and colleagues who look just at tips, at break-even inflation. We have other folks who look at surveys. We have other folks who look at econometric models, look at the Cleveland Fed trim mean, Dallas trim mean, or trim median. I look at all those. What I have said, indeed, Loretta, you and I think the last event we did, maybe pre-pandemic, was at that New York conference in February of 2020. And I think at that event I said that I look at all those indicators of expected inflation, but if they're moving in opposite directions, the one I pay most attention to are the survey measures, because ultimately, that's what it's about. I mean, if the bond market thinks this and Stock Watson thinks that's good to know. But the public thinks about inflation is important. So, for example, the Michigan survey, which goes back 50 years, I follow, and of course, the Fed staff has an index essentially that takes all those measures of expected inflation and tries to average them in a sensible way. So. That's
so you're comfortable now where inflation expectations are?
I'm comfortable now where inflation expectations are. By all those measures, or by most of those measures, they have moved up relative to where they were a year ago. But a year ago, I thought they were sort of at the low end. So the fact that they've moved up is not something that's of concern to me now. But the reality is, with the increase in oil prices, we do see sensitivity of near-term inflation measures that are certainly well above to our 2% longer-run goal. Many measures, for example, the Michigan survey is now back to levels that prevailed like in 2014 or so. So it's moved up a lot, but not at a level that's now concerning. But I think we have to watch them closely.
So if I think back to the language that we put in their statement, on the forward guidance on the funds rate.
Yeah.
When we put that in, I think many of us thought, like, if we're going to be approaching the 2% goal, we're going to approach it from the bottom.
Yeah.
Right? Now we're going to be approaching it from the top. So that experience, does that, and I'm not going to ask you about your current view, but does that sort of change how you think about the formulation of forward guidance, and maybe we need to think more scenario-based as opposed to sort of just, saying current conditions and therefore put in forward guidance?
Sure. Well, obviously, and as you know, in Teal Book, we have a lot of scenarios we look at. So I think scenarios are important. What I would say, and I've tried to give public speeches on this because I think it was important, at least for Fed officials, to talk about how our new framework operates when inflation will be approaching 2 from above. And the way I think about it is really our guidance. We've given a 2-part test. So, in my mind, if we were making the decision today, we've certainly met our condition on reaching 2% and more than moderately. But we gave a 2-part test really to lift off, which is not only that, but the labor market. So I think that is serving us well. I think that's serving us well right now. But it will also be important, as the SEP projections, have indicated. Many members of the committee believe in September, I think half the committee believed it would be appropriate to begin lifting off in 2022. Not inconsistent with the new framework, but consistent with a view that we've met both of the metrics. So I think it will be important to be consistent, because ultimately, as your prior question indicated, Loretta, at least with price stability, this is about well-anchored inflation expectations, and so getting actual inflation, down close to 2 is going to be an important part of keeping those expectations anchored.
And one more question.
Yeah.
As you said, right, the new framework it took a while to communicate what that meant because we changed the framework and we wanted to convey our reaction function. Do you feel that the markets and the public understand the new framework and what it means and what it doesn't mean now? Or do you think we still have more work to do on that?
It's a new framework. No one else has implemented it, and certainly no one's implemented it with this sort of a supply shock. So I think, I think communications is always a work in progress, and so I think, I think we certainly, as we're making our decisions and talking about our reaction function, it'll be important to tie it into the new framework. Agreed.
Well, I have a couple more minutes here, and I have to ask you some questions about your feeling about the Fed. I mean, you came in, you were a student of monetary policy and central banking, not only in the U.S., but abroad, and you're going to be leaving us. What surprised you? What didn't you expect when you got to the Fed? Like being a student and being in the financial markets, was there anything that you got there and said, wow, I can't believe the Fed does this, or I can't believe the board does that? Did anything strike you that way?
I guess I'd mention a couple of things. One is when you're a Fed watcher or a professor who lectures about the Fed, you have the luxury of just focusing on one important but sort of narrow piece about what the Fed does, which is in most times what the Fed's doing is raising or lowering the funds rate by 25 basis points. And once you get inside, you realize there's an interplay between raising and lowering rates, the forward guidance you choose to offer or not to offer, what you're communicating or not communicating about your balance sheet, and then the way all of those interact with financial stability and supervision and regulation. And so that was I really began to appreciate, for me to make a decision on any one of these, I've got to have some understanding or sense of all the others. So I would mention that, and it did. Even as a Fed watcher, Loretta, I will confess, it seemed to move very, very fast in those first several meetings. The amount we absorbed going into each FOMC cycle, and the fact that we're all thinking about 1, 2, 3, 4 meetings ahead. You can write down simple models where central banks at every meeting just look at inflation and unemployment at that meeting and raise or lower rates. But in practice, we're always really looking ahead several meetings. Milton Friedman's famous, long and variable lag. So you add the interactions among all those pieces and the fact that we're needing to think ahead. Conceptually I understood it, but when you're actually making decisions in that environment, it was a lot to absorb initially.
Well, your expertise was really crucial during the pandemic and even before the pandemic, bringing that practice and theory into it. And one of the reasons that the Fed did, or the FOMC did, the review of the framework is because of changes in the underlying economy. Yeah. So when you look out, if you had to sort of give advice to the Fed or think about what challenges the Fed's going to face going forward, what would be the top 3 things that we should have on our, radar to look out for or to just try to address?
Well, I guess I would highlight we rolled out a new framework, and we've been communicating a new framework, but it'll be very important in coming years to actually execute on the new framework. I don't think that's a subtle point, but it's an important point. I do think institutionally, there will be focus and attention on the size of our footprint in markets, and I think it'll be important for the Fed in future years to make a decision, about that. And then again, as I said in response to your earlier question, I'm very much in the camp both going in and coming out of the Fed, that even though we've done 2 rounds of 13.3 interventions in 14 or 15 years, that those were 2 very severe downturns, and I would certainly hope that the Fed institutionally can resist an evolution of what we now think of as unusual and exigent 13.3 facilities as part of the regular toolkit. So.
Well, thanks for that. And thank you very much for being here. Thanks for your remarks. Thanks for the conversation.
Well, thank you, Lorena.